What's up, everyone? Welcome back to the Outlier podcast. I have my friend Joe here, and you and I connected like 2 years ago or something like that now?
It's been a while, man. Yeah.
Yeah, I like originally reached out to you when I first started YouTube just to try to like figure out how to not completely dork everything up as I've done anyways, against your best advice. So I guess I am a poor tutelage in that sense, but I am absolutely stoked to connect with you a little bit. And you bring a different perspective than what a lot of my standard audience is used to seeing. So, as we were talking about right before we started recording, a lot of like active trading, derivatives style stuff. And you spread a pretty wide gamut of things. And I know a lot of what I see on your channel is kind of like the dividend investing side of things. That seems to be something your audience likes a lot. So, I'd love to start with a generalized background. Obviously, you spent some time in the Marine Crops, which is how we came into contact together. And then, so I'd love to learn a little bit more about your military experience and then making the transition from there.
Sure. Well, yeah. Spent time in the Marine Corps as an armorer. Got out in 2001. Just before it really hit the fan, obviously. Always knew I liked making my money work for me, right? Corporal in the Marine Corps doesn't make a whole lot of money, so you got to have that money working for you. So I got really heavy into investing. Of course, 2001, 2002. This was just as the real estate bubble was starting to inflate. So everybody was making money in real estate, and I wanted a piece of that action. So I got started. Went back to school, went back to college, and got my degrees there, finance and communication studies, and started on the real estate side as a real estate analyst. Of course, that all blew up in 2000 and 2007, 2008. And of course, it's weird because my professional career, the career path that I thought I was going to take into real estate as an analyst and investor, and that blew up just as when I just first started investing in 1999, blew up as well. So I seem to have a knack for finding things, making an inflection point in my life, and then it just blowing up completely. So we're still waiting for the third act on that one. But anyway, so I've spent some time in real estate. When that all blew up, I kind of transitioned into equity analysis, so stock analysis. I worked in a venture capital firm in a Canadian venture capital firm, set up their sell side division, and worked that. So I was a professional analyst for about 10 years. And then finally decided, these 80, 100-hour work weeks were for the bulls. So I started kind of freelancing while I was building up my digital assets, my online business with blogs, and then finally with YouTube, really trying to build my own assets and something that I actually owned, right? Because, anyone in finance, they could tell you they work their balls off, but they own nothing, right? So they have to constantly be grinding that wheel. So I built up my online assets, and here we are. I love talking about stocks still, love watching my money grow and having it work for me, and I love being able to bring that professional equity analyst background to YouTube, where you don't often get something like that. Um, probably a little bit longer term investing style than what a lot of people are. I do like to swing trade, so 3 months, 1 year kind of trades. But then beyond that, kind of try to take it easy and just let the money work its way out. So I'll use options for swing trading, but also for hedging longer term. And then futures, probably usually futures only in the forex sense. So times like now where the dollar is completely ridiculously overvalued, and it has been for the better part of a year. Then I'll put on a futures trade, short the dollar into some other stuff. But mostly it's just stocks, stocks for the long term, growth stocks. I do. Everybody likes to make that cash money on the dividends, but it's kind of hard to get rich with dividends. So I kind of stick to the growth stocks, tech stocks, things that are going to multiply your money, get that portfolio to the point where you need it, so you can be living off your dividends one day.
Bunch of questions.
Sure.
Yeah, the very first one, not market related yet. Did you think at any point that you were going to like be a YouTuber? Did that ever cross your mind?
Sure. Well, I mean, we didn't even there wasn't a YouTube until 2006. So, right, so I was already 30 years, 30 years old before YouTube was a thing, right? And then even then it was for gamers and I don't know, weirdos,
Oh yeah,
14
still
year olds that
is.
would 14-year-olds that would soon become the biggest YouTuber in the world, right? I think Mr. Beast had his in 2006, 2008, something like that. But yeah, no, I didn't. I started blogging in 2013, right? When I, finished on my equity analyst career, really trying to start building those online assets. And I started the YouTube channel in 2015, but only as a way to put videos, host videos on YouTube so I could put them on my website so people could watch them on the website and, spend a little bit more time there. Didn't really think much of it until, I saw a huge, huge spike in hits one day to the website. And what had happened is, a friend of mine had that with a YouTube channel had talked about one of my posts and sent massive amounts of traffic. So I was like, well, shit. And this was 2017, by the way, 2 years after I had actually started the YouTube channel. Hadn't really done anything. I think I had 10 videos on it in 2 years. And I thought, okay, well, YouTube is a thing, I guess. So I started in 2017, December 2017, really putting videos on there for YouTube's sake to build that part of the business. And it's pretty much all YouTube now. I love the face to face you get with people on YouTube. You just don't get that in blogging or even in podcasting if you're not, recording the video and posting it somewhere. So I love that sense of community you get with YouTube, really being face to face with people.
Yeah, it's fascinating. The reason why I asked that question too is because I find my foray into YouTube very similar, and I'm always wondering how other people came into it. Quick story that I think is kind of funny. We had a bee infestation outside my window here, so called a beekeeper, came out, helped us with the bees. As he's leaving, he like looked at me and he's just like, "Are you like a YouTuber or something?" And at that point, I'd never touched any social media. I didn't even have an Instagram. So I thought it was the funniest thing on earth. I was like, fuck no. Like, who's on, like, why do you think I would be on YouTube, right? Like, just so crazy to me. No shit. By the next year, I had started a YouTube channel and had been
Wow.
off to the races. So this
But
freaking
you
beak.
were you were podcasting, right, at that point. So you had
Oh,
the setup? No. He just asked if you were you. That's
he
kind of
just
crazy
randomly,
out of the
it's
blue.
Yeah, the main thing is like we're fortunate. So we live in a nice house in a nice area, and I looked a little younger than I do now. So I think he saw a younger dude in a nice place, and he was curious like how that happened. Right, that's
Okay.
pretty common out in California at least. But it's just so funny to me that like I thought that was the most ridiculous thing on planet Earth, and then
Should have told him no. I just married a sugar mama. There you go.
I told him I told him I was a prostitute. That's my go-to.
There you go.
Whenever anybody asks me what I do, because if you think about it, if you
Which which is crazy because that's the more legitimate answer than yeah, I'm a YouTuber. People still think, can you make money on that? Is that a
yeah,
thing?
yeah. They're like, oh yeah, that makes sense. You sell your body. I get it. But
Yep, yep.
I mean, my argument there is I feel like in a nutshell, we all are prostitutes because we're exchanging time and effort for money, just different kinds of effort. But
Okay.
yeah,
I guess you could make that case for many other careers, but
yeah,
that they're somehow prostituting
that's
their
exactly
time
it.
anyway.
That's exactly it. But I just find that so funny because a lot of the people that I find that are doing really cool things on YouTube, like you, seem to just come across it randomly, right? Like you started your YouTube channel, 2 years, 10 videos weren't doing anything. And then all of a sudden, your friend dropped you and it started taking off. And you're like, okay, I guess I'll do this too. Like, that's so cool. I
Yeah,
love that.
it's totally random. And I will say I was fortunate enough to start in 2007, start relatively early. Even 11
Right.
years after YouTube started, it was still relatively early, and I had that benefit. And it is more competitive now, but it is still really early. It feels like there's even at something like 26 million channels on YouTube.
Yeah.
It is still an early time to start a YouTube channel. So for anyone out there that just wants to be heard, wants to make some money, and wants to build something, then YouTube is still the place to be.
Yeah. I couldn't agree more with that. I mean, it's what the second largest search engine right now. And the cool part about YouTube is even though there definitely is saturation, what I've come to appreciate is that there are areas for you to carve out for like your personality, your brand, and what you do. Because somebody like you, even though YouTube started in '06 or whatever, and at that point it was brand new, you had already been doing the finance thing for some time before that even started, right? So like you're coming to a place with a significant amount of experience that even though a brand new YouTuber might have really good marketing now, they don't have the experience you do. So
Sure, sure.
that part always provides a pretty strong differentiation, which leads me to my follow on. So I would love to know more about your experience, what you did, and the overall perception you had of working at the VC firm and equity analysis. So you can start from the very beginning, specifically why that place, and then just kind of go from there.
Sure, sure. Well, equity analysis, I mean, anytime you start, anybody starting as an equity analyst, you always start as an associate, which is basically a peon. Not only are you going to, the gopher going to get everything for everyone, but you're also really just doing cash flow modeling, right? You're sitting in front of a computer screen. 9, 10 hours a day, at least minimum, basically on an Excel spreadsheet and modeling out a company's cash flows, right? Everybody likes to follow income, net income, that's, PE ratios, all that kind of crap that's on CNBC. It's easy, but that's not really where analysis comes from. Investment analysis, the way they do it is really modeling those cash flows. How much free cash flow does the company have? How much is it going to be able to spin out to investors? Theoretically, if it wasn't saving it back for growth, and what's the value of that? All those future cash flows. What's the value of that in the present, and how does that on a per share basis? So you're basically just kind of, a grunt, to put it in a term we both know. You're basically just a grunt for on Excel for, yeah, 10 hours a day, forever, forever it seems. Year and a half, 2 years, then you
Quick
get then
follow
you
up on
get
that. So sorry to interrupt you. I just want to
yeah.
follow up on that first part first. So 9 to 10 hours a day working on cash flow analysis.
Mhm.
Can you walk me through like functionally what you're actually doing 9 to 10 hours during the day? Like, are you going to websites? Are you trying like what are you
Sure.
functionally doing during that time frame?
Sure. Well, a lot of it goes the financial statements, right? And if anybody wants to learn real investment analysis, the way they do it, to be able to recommend stocks and all that, pick up at your local library and old copies of the CFA curriculum, right? The Charter Financial Analyst. You'll go in there and they've got, everything from, I mean, it's a stack of books like that, right? For each year, there's 3 levels of it, but you can do first level, second level. Get those books, and they'll walk you through everything from economic analysis, macro level analysis, all that. But the real bread and butter there is financial statement analysis, right?
Got it.
It's you go into the income statement, the balance sheet, and the cash flow statement, and really, again, you're looking at what the company has reported in the past, the past 5 years or so, and then you're trying to model out into the future what the future looks like. And of course, so one, you've got management expectations, what they're saying on analyst calls, quarterly reports, what they're saying in their corporate presentations. What they're not saying is a lot of times very telling, right? So and what happens is analysts, you don't really, most people don't realize it, but analysts usually only cover maybe a few industries or 1 or 2 sectors, right? Because you have to get very good at those industries or those sectors, right? So you might be a consumer staples analyst, or you might be a tech hardware analyst, or something like that. And you get to know everything you can about the tech hardware industry, right? So you not only follow that company, but you follow all the companies in the industry. So 5, 6, 10 companies in that industry. You learn, okay, what do they typically talk about on their analyst calls? What are the metrics that really go with that industry? What kind of growth is average? What kind of growth is medium? What their inventories look like? What their inventory spending looks like? And with that, you get a feel for, like I said, what they are talking about and what they're not talking about. If they're if all the other competitors in the industry are talking about day sales outstanding, or some of the other inventory measures, and there it's conspicuously absent in whenever management talks about it at this other company, then you kind of wonder, okay, why aren't they talking about it? And you research a little bit further. So you're looking at financial statements all day. You're digging through the notes to the financial statements to see how they're accounting for things on those financial statements. Because even though there's well called GAAP, generally accepted accounting principles, kind of guidances for how companies need to account for different things like revenue and expenses. There's a lot of leeway in there that companies have found ways around to make their own accounts look better or something. So you're digging through those, and then again, you're trying to model out what they've done in the past, what maybe your macro people, because usually a lot of times your analysts, they're just doing those cash flow models and the financial statement analysis. Then the firm has maybe macro level people, so economic people that are saying, okay, the general economy is going to grow this much over the next 3 to 5 years, and you've got kind of models that say, okay. If the general economy grows, if GDP grows 2 to 3%, then we can probably say maybe 7 to 10% or 15% growth in this industry, right? And you've got other industry analysts telling you that as well. So you're applying some of those numbers that you have, as well as what management at all 10 of these companies in the industry are saying, and you're trying to model out, okay, what do I think sales are going to be for each of these 10 companies in the industry? Who's got the better expense management? What are their expenses are going to be? Who has capital expenditures that are just running away, and maybe that's going to deflate their earnings a little bit. So you're really trying to get a feel for, what earnings, what net income is going to be over the next 5 years. You're modeling out their cash flows. Again, very important that you adjust the income statement to their cash flows, which is, because okay, the income statement is all those accounting shenanigans that everybody uses, and nobody really says anything until something goes wrong, right? Until you got a super microcomputer and somebody calls them out on it and the stock falls apart. Everybody does those kinds of accounting shenanigans, those manipulations to make their revenue look higher, their expenses look lower, and make their net income look better. But nobody ever really says anything because it's a game everybody plays and everybody knows it. So you're kind of trying to think through, okay, the income statement has all these accounting shenanigans, these manipulations on it. The cash flow statement is actual cash generated by operations, cash spent in investments, and that free cash flow that, is basically theoretically what kind of cash the company has left over after paying their capital expenditures from their operating cash flow. So you're really trying to tie those two statements together and see what that cash flow looks like, and really, which companies are the better at it in this industry, in your industry, right? So again, it's a lot of work. You're looking through industry reports. You're following if there's any industry magazines or industry research. You're following that. So it's not really. I mean, you're not just sitting at your desk watching an Excel screen all day long. You're building up all this information, this research that goes into, okay, what's a good rate of growth for sales for a company that has this kind of market share? Who has the market share in the industry, and how is that changing among companies? So I mean, that's why equity analysts get paid a lot of money, right? So, but it's also a lot of work. I was reading in the Wall Street Journal probably last week, and it kind of brought a lot of realities or a lot of memories back to me because it was all about the hours of work in investment banking and equity analysis, and how a lot of these junior bankers and junior analysts are being overworked. Of course, we never said we were overworked when we were back in the early 2000s and that time, but and how they're coping with it with ADHD medications and
Oh yeah.
Red Bull laced with Ritalin and all
Hell
that kind
yeah.
of good stuff. So it's just kind of a fact of life for bankers and for equity analysts. Um, so I did that. I did that for a few years. Figured out that I wanted a little bit of change. I wanted to in something a little bit prior to equity analyst analysis. So I started looking at venture capital. Worked in a venture capital firm for a couple of years, and then was hired by a Canadian venture capital firm called High Alert Partners to put together their sell side division. So I managed a team of about six other analysts, and we kind of analyzed stocks and analyzed other pre-IPO private companies for the owner, and kind of drove business that way.
Fascinating. And so first off, thank you for the detail on just what the day-to-day looks like. Because I think that's one of the things that a lot of people that don't work in the industry never get a sense of unless they have
No.
an opportunity to talk to somebody like you.
Yeah.
So
Yeah, I mean,
sincerely,
you watch CNBC or YouTube. I mean, I think more people get their stock picks and information from YouTube now than CNBC. But you watch and you watch these guys, and myself included. I never go into that much detail. I mean, I do a lot of the work behind the
yep.
scenes, but I don't go into that much detail as far as, okay, this is why I'm picking this stock. I've modeled out these 5 years of cash flow for this company. I think it looks great. I think it's worth much more than people are paying for the shares right now. So you can get a sense that it is just that easy. You just, oh, hey, look at
Yeah.
the biggest thing I hate on YouTube right now is just the chart porn, right? People will
Oh,
look at,
hell
oh
yeah.
man, look at Nvidia, look at that chart right
It's
there.
clear as
Oh,
day.
that looks beautiful.
Yeah.
Buy that. It must be going that way in the future. But that's what a lot of YouTube is now, is just that chart porn,
Awesome.
that people, finger f in the chart
Who
and
cares?
and thinking it's going to keep on going just like that. So yeah, you people don't get a sense that of what investing really is and how how professional it can actually be if you actually are doing the work behind it.
Yeah, but it's much easier just to be a degenerate and just say stonks go up and then
Yeah,
just
yeah.
YOLO
Eh, Yeah,
it.
and I don't know. I mean, I guess I've benefited from the ease of having a YouTube channel just as much as anyone, right? You don't need experience. All you need is a camera and an opinion, and that's great to bring more people, give people the opportunity to have a business of their own. But yeah, it's not the greatest, not the best way to invest if that's all you're doing is following a chart up or just following easy stuff like the PE ratio and saying, oh, well, this is a cheap stock. It must be a good deal.
Which is interesting. Are you familiar with Wesley Gray's work in Momentum?
No.
So he's a Marine dude, solid guy, and he runs Alpha Architect, which is a big ETF fund. But anyways, he is a momentum junkie. That's what he spent a lot of time on his PhD working on, and he's come up with a lot of different factors with respect to momentum, frog in the pan concept. The Cliff Notes version to this whole thing is one of the dominant factors with respect to momentum is obviously an X period lagging return. So 6 months, 12 months, both tend to be pretty efficacious and they tend to resist the short-term turnaround effect of other things that 3 months has a strong turnaround effect. But what they found is when you overlay that with some of these fundamental indicators like you're talking about, like PE ratio or PEG ratio or free cash flow, that it can like massively improve the performance of the system, which is interesting. But funny enough, PE ratio, just as you pointed out, is actually one of the less informative overlays that you can input, which
Sure.
is interesting
Sure.
that you've also mentioned in that there.
Well, sure, because earnings by the time earnings come from the income statement, right? And by the time you get down from revenue all the way down to earnings, you've got so much shit in there as far as accounting manipulations and
Oh yeah.
shenanigans that you don't know what earnings really are. There
Right.
are all kinds of ways to speed up your revenue recognition. As far as contracts that might be signed or may not be signed, and all kinds of ways to basically you're giving out credit where you're not going to be paid on that, but you're recognizing that revenue. And anyway, there's all kinds of ways to make that earnings look so much better than it actually is. So if you want to use maybe a bit better one to be like price to cash flow, that kind of thing. But yeah, I agree. I don't use technical analysis a whole lot or kind of momentum analysis, but a great way to do it is, yeah, using that as a buy or a sell, as an indicator, a buy or a sell point for the stocks that you've done the fundamental analysis on. And you want to buy the stock, but you want to know, okay, when is a good time, when is a good price, and that technical analysis can be a great way to say, okay, yeah, now is the time to start buying. You're going to have the lagging returns tend to be good on that, and the long-term returns are good on your fundamental analysis.
Yeah, yeah. It's it's really interesting to see the cross section between analysis because I always find it interesting when both traders and investors they'll kind of poo poo on one or the other. They'll say, "Oh, this is trash" or "This is trash," and I always think it's like, why would I close one eye when I have two eyes, right? Like use
Sure.
them both. Um, Now, Going back though to your transition from specifically equity analysis into the VC build out side of things, what made you make that transition? And what were some of the larger differentiators in your day to day between those two jobs?
Okay. Well, I think, I mean, first you look at the money people are making, right? So venture capital, you're getting in much earlier than equity guys, right? So, you're getting in, and back then, early 2000s, and that was, and mid 2000s, I think there were more opportunities in venture capital and pre-IPO investing than there are now. Right now, there's just so much money floating around that companies are staying private for so long that it could be, 5, 10, 15 years before you get an exit. Basically, for a lot of these private companies, you're investing in a company. The idea is that it's going to, have maybe 4 or 5 funding rounds, investment rounds into it, and then they'll look for an exit, right? Either to sell the company to through an acquisition to a bigger company, or they'll do an IPO. And generally, you can do, I mean, very, very good returns. There's a study by Willamette University that looks at angel investing portfolios on a rolling 4-year period, and found annualized returns of about 24% on those. So very good, and that's even with about half the portfolio just completely flopping. Right, it's one of the just a fact of life for pre-IPO angel venture capital investments is that about half of them are just going to bust. Those companies are going to just go away. But then you've got enough that are 30, 40, 50 times your money that bring it up to that 22, 24% annualized return. So very strong returns. Anymore though, you've got so much money sloshing around just over the last 5 years from all the stimulus and all that, and going, being available to these pre-IPO, these private companies, that they're staying private forever. I mean, you've got companies like, I think, well, XAI, you've got, all of Elon's companies, right? You've got, there's a couple other ones, but $60 billion market cap, $100 billion market cap, or valuation, which is just unheard of. I mean, these companies, we used to say $1 billion was, a unicorn and a good time to try to go IPO. And you've got companies just staying private forever. So there's no exit for those people. But anyway, I kind of digress there. Back in the early 2000s, mid 2000s, I mean, you were getting much more frequent exits for these companies. And so, the investors and the people in on those deals were making a lot more money. So I was kind of watching that. I decided I wanted to make a lot more money. Wasn't necessarily
Good choice.
wasn't necessarily starving to death as an equity analyst, but you're kind of beating your brains out over that market return and maybe a little bit higher. So I started looking into that. I really liked the idea of getting in before, everybody else did, right? You get in pre-IPO, you get into those private companies. I liked the idea of, a little bit more of a control and ownership and guiding ownership into the company. A lot of VC firms will have people on the board of directors of their investments. So there's always an opportunity to join the board of one of these private companies and kind of help guide it, help steer it. And of course, that's always a paid thing also to be on a board of directors, and you get more stock options and stuff like that as well. So I just liked a lot of the things in that. But it's as far as the work involved though, it is very similar though to an equity analyst, right? Especially when you're first starting out as a venture capital analyst, it's going to be very similar because basically you're just taking that company and looking at its financial statements, trying to project something into the future. But also you've also got a little bit more of a guiding and managerial role, right, where you're trying to tell them, okay, this is what's working in the industry. This is what's effed up about your company right now and what's holding it back, and these are the changes you should make. It's a little bit more detailed, a little bit more in depth, a little bit more detailed and managerial focused than an equity analyst.
And which did you like more?
I'd say the venture capital, right? Again, it gives you a little bit more of an opportunity to be, uh, you know, I won't say the manager because you're not actually managing the company, but you've got your strategy hat on and you're actually helping them to run the company better, find new customers, find new suppliers, really make that company something that could be, someday the next trillion or well, I won't say $1 trillion company, but the next, the next $1 billion company, the next IPO, big IPO, and something that's, going to pay off big because again, the big exits are fewer and far between, 30, 40, 50 times your money. But when they happen, I mean, that's just like the sun shining out through the clouds, 50 times your money on an investment. It really shows you why you're in this business.
Yeah, that makes a ton of sense. It also seems, at least for somebody like you, probably a better use of a diverse skill set because you apply some of the technical expertise, but you also apply some of the managerial side of things. Did you like the managerial side, or was that kind of annoying and you prefer the more technical stuff, or different than that?
Sure. No, I liked it. Obviously when you're used to and at this point in my career, I was still fairly new. I had just been associate in equity analysis and I was still doing the grunt work in these the Excel spreadsheets, the deep research. So it is always nice to be able to break out part of your day to really look at something a little bit bigger picture, right? And
Right.
sit on the board of a company and have that networking that you have with those newer companies and as well as with investors and other people in that industry. So it's always nice to have, to do something different other than staring at a computer screen all day.
Sure. What were the board meetings like that you would sit on? Like, what would you do? What would they talk about? What were the ins and outs of that?
Sure. Well, most of them are very procedural. Once something gets to a board meeting, it's basically been talked about and rehashed and hashed and rehashed ad nauseum, just between the board members and management and that kind of thing, and their advisors, advisors from the VC firm and that kind of thing. So the board meetings tend to be actually pretty short and procedural, because everything's, I won't say a rubber stamp, but it's again, it's already been talked about, hashed, rehashed into basically how the vote's going to come out for a specific project or an idea. So the board meetings are all pretty easy. Basically, it's everything you do before the board meeting, where you're just talking to management, where you're talking to some of the other board members, where you're talking to the advisors. Just kind of looking at where the company is going, what can be improved, where its weak points are. A lot of times trying to figure out if you can find a better supplier for something, trying to make those network connections, because and that's what it's half of what successful venture capital firms are, is just really making the network connections between their companies, between their invested companies, together, see who can be a customer of who can help out somebody else, and help who might be a good merger eventually someday. So you're really kind of try to play that networking a lot with the other board members, with management, that kind of thing.
Sure. And overall experience there, good, bad, indifferent?
Good, really good. It's again, if it wasn't so much, I was able to build up investments, private investments into companies myself through that. But again, other than those investments, I really didn't own, a lot of my own work, right? My own work was for someone else. It was for, in someone else's business. So if it hadn't been for that, maybe if I could have been like a partner in that business, then I would have stayed. But again, I wanted my own thing. I wanted my own assets. Obviously, even in the mid to late 2000s, the internet still felt like something very new as far as a business idea and as far as creating a business. Of course, somebody born in 1976, it would still feel new. I'm sure somebody born after 2000, it feels, hell, the internet's always been there, right?
Right. Yeah, yeah, very different. Um, Switching gears a little bit now to the actual practice of fundamental analysis. When you think of fundamental analysis as a concept, what does it mean to you?
Sure. Well, trying just as I did as an equity analyst, trying to find the present value of those future cash flows, and excuse me, and and where makes the most sense to place an investment over the long term, right? And the thing is, there is so much there there is so much sentiment value in there when you're talking less than a year, right? If you're talking stocks less than a year, it's all investor sentiment. It's all the overall market, right? Where the overall market is going to go, where investor sentiment is going to go, that's what drives stocks in over under a year, right? Beyond that, so if you take a little bit longer approach, a little bit longer horizon, then it is okay, which stocks, which companies have that competitive advantage? Okay. And, it's one of those words that's thrown around so much, it really means nothing, but it's a little bit easier to see. You can get clues to it from an operating margin, from a sales growth perspective. Again, it's a little hard on YouTube because you're expected to know all stocks in all industries. But again, it's easier to just to focus on one industry, so okay, what's a good operating margin in that industry? That profitability. What is a good sales growth? What are the companies getting as far as sales growth, and who's getting the higher sales growth, and why? Why are they able to get 25% revenue growth each year when the average is more like 15? Does that point to a competitive advantage that they're doing, that, either their product, their marketing, just a brand, something like that, that they're able to steal market share from the rest of their competitors, right? And then operating margin, of course, is there some kind of a competitive advantage they have in the management of that company, of the expenses, not just holding off expenses, so not investing in the future, but are they actually, investing, putting as much money or cash flow, from the cash flow statement, are they investing in the future, but they still just, beat everyone else out in that operating profitability. So that's really, through that fundamental analysis, the analysis of the financial statements, it all goes back to there. You know, where do you find the companies that have that advantage? And and that's always going to lead to better returns in those companies. Any company, obviously, it might seem it's intuitive and it might seem simplistic, but any company growing sales faster than its competitors, any company that has some kind of a competitive advantage that's leading to higher profitability, it's going to be the better return. You know,
So if you were to think of three of your favorite fundamental analysis indicators, it sounds like sales growth would be one of them. What what would the three be?
Sure, sure. Well, definitely sales growth, but it's got to be in relation to, the other companies in its industry. Okay, so when you're comparing stocks to buy, or when you're looking for stocks to buy, you always have to compare, a stock against against other companies in its same industry, not just the same sector, but in its same industry, right? So you can't compare Coca-Cola to Nvidia. Okay, because obviously Nvidia's sales growth is just going to, blow the doors off Coca-Cola. Doesn't mean Coca-Cola isn't a good company, isn't a great company. It just means it's two entirely different industries, right?
Well,
You got to compare
the
Coca-Cola to Pepsi and to, Monster Beverage and that.
the I think the question there though is, does the Coca-Cola CEO wear an alligator skin jacket and sign people's bras? Right? Like that
Exactly.
that
Yeah.
to me is more what I'm
There is definitely and it's funny, but there is definitely an icon kind of value to a company. Okay, the kind of value that, okay, yeah, Jensen Wang, that Elon Musk add to their companies. Uh, it's an intri or it's a intangible value that,
Mhm.
whether you add it to the stock or not. It's kind of weird. It's kind of crazy to think of it like that. I can't really think. Well, I guess we did, back in the day, we did have CEOs that were a little bit larger than life. We had Jack Welch over at GE, Bob Iger was still at Disney, but in the old days he was, at Disney first. And these guys were larger than life. They were media, they were, I won't say superstars or even stars, but people knew who they were. They were role models, but they weren't the rock stars. Yeah, you're right. That Musk and Jensen Wang and I mean, even I won't say Tim Cook is really in that league, you know. But yeah, so yeah, there is something to be said for that superstar status and what that means for the stock price. But yeah, you gotta compare apples to apples, right? So you're always looking at companies within the same industry. Okay. what's you get your Excel, you get your old spreadsheet out there and line them all up. Get the revenue growth, not just 1 year revenue growth, but how have these companies grown revenue over the last 5 years? An annualized return or an annualized rate. What's the average there? What's the median? Who's got the highest ones? And really, why is that? It's like, again, like I said, it's a great clue into who might have a competitive advantage. Why is one company able to get revenue sells so much higher than the others? So it's definitely something that you want to look at, but only in comparison with the others. Operating margins, same thing. Operating margins, basically just your operating income. This is all on the income statement. Your operating income divided by sales, and it's really that core measure of profitability, right? Because it's you've got your revenue minus your cost of goods sold, which is basically a lot of factory expenses, your supplier expenses, things like that. Then you've got your operating expenses, which are selling, general, administrative, marketing, things like that, some other operating costs, and that gives you your operating income, right? So, further down on the income statement, you're going to find your interest, your taxes, things like that, things that really aren't a part of the business, running the business, right? So that's why I like to use operating income divided by revenue. That gives you your operating margin. It's really a core profitability for that business. Okay, so that's and that's again compared to others in the industry. How is one company able to do so much better on that profitability than the others? Why? Is it just better managed? Do they have a little bit more power over over their suppliers? They're able to get lower costs, things like that. So it's a really good clue into how this company is being managed, which might have competitive advantage. You've also got just cash flow, free cash flow growth, uh, operating cash flow growth. For it's a little bit different for really early stage companies where it might be negative cash flow, negative earnings, things like that. You have to really look at the balance sheet as well. Is one company, is it growing, but it's so far in debt or so far negative cash flow that they're not going to survive, if they don't have a big stockpile of cash on hand. But it's really for most mature companies, it's really just about that growth and how they're able to generate it, right?
Now, you're talking about for revenue growth, for example, you talked about using like a 5 year annualized. When you're conducting this fundamental analysis as a broader process, first, what do you think about the relevant timeframes for your analysis? I imagine it has to be partially based on your expected holding duration. Is that accurate? Or how do you choose what timeframes are most relevant for including prior data points?
Sure, sure. Well, of course, yeah. If you're planning on holding it for 5 or 10 or 20 years, you can look back, 5 years. Of course, it's got to be to the point where you're really kind of looking at, what happened in those last 5 years. What were the major, economic themes, right? Was the government just throwing money at everything? So everybody, of course, everybody had 20, 30% revenue growth. And so you kind of, hedge it against that. So you kind of have to put everything into perspective. But I would say 5 years is good. For maybe some of the older companies, you can go back, 7, 10 years just to see, just to compare. Okay, so Coca-Cola versus Pepsi over the last 10 years, then over the last 5 years, has something changed? Is their revenue growth over the last 10 years in relation to each other? Has that changed from 10 years to 5 years? And why? What's management doing? So you really have to look at, and again, these looking at these, I don't want the sound to sound too simplistic because you're not just looking at, okay, hey, this company has the higher revenue growth, this must be the better investment. No, you're looking at that, you're trying to use that as a clue for, okay, what should I look at in this company? Okay, if I found that Coca-Cola has 15% revenue growth annualized over the last 5 years, all of its competitors are 3 to 5%, then I want to start looking at Coca-Cola and I want to actually find why. Why is it revenue growth? Is it buying that revenue growth? That's something you have to look out for a lot of these companies, just acquiring other companies. Yeah, their revenue growth is going to look great because they're buying it, right? They're probably putting on mountains of debt to buy these other companies. Their revenue looks great, but it's going to come out and bite them in the ass when when all that debt comes due. So you really have to look into the company, say, okay, Is it because of some kind of strategic genius the management has? Is it some kind of competitive advantage in the brand, in the product, in the marketing? And can that be, obviously, is that a durable competitive advantage that's going to last out over this 5 or 10 years? That's really where you got to take that simple, those kind of simple metrics that you can look for. You got to take it to those, to that level to really find those. And the thing is, I mean, for that real long-term investing, the good thing is you probably only have to do that maybe once every couple of years, right? Because you're looking for something that is durable, over the next 5 or 10 years. So basically, you're finding that you're investing in it, and then, if the stock doesn't, if the company doesn't do as well over the next 2 years, 3 years, then you might revisit it and see, okay, what did they do differently? Is it just a hiccup in time, or do I need to reevaluate all of these? But this isn't something you're doing every month or even every year. So it is a lot of work. But once you find those companies, then you can hold them forever, basically.
How do you choose sector? Because we talked a lot about comparing within sectors. We talked about not being able to compare, the fact that NVIDIA, they have a rock star CEO that's signing people's bras. And I don't even know the Coca-Cola CEO right now. So that tells you a lot. So how do you pick which sectors make the most sense for you?
Sure. Well, a lot of it comes down to just your goals, right? Obviously, some sectors are gonna grow faster. They'll have those faster revenue growths, and should produce better returns. So, right, so you've got your technology, your communication services, which used to be all of the old telecom stocks, but are now mostly internet stocks and things like that. So a little bit faster growth. Consumer discretionary tends to be kind of a growth sector, right? And then you've got so if you want that portfolio growth, you would pick maybe one or two of those sectors. If you want maybe a little bit more stable returns, safety sectors like utilities, like consumer staples, like healthcare, things within those, then you would pick those. And again, probably the thing people don't realize about real investing when they just watch YouTube and they watch people pick stocks from all different sectors and everywhere is, again, it pays to be very specific in your expertise, right? So what I always say is, okay, hey, pick one sector or maybe a few industries in different sectors. So if you want to pick, a couple of industries out of tech, a couple of industries out of, communication services, pick a couple of those industries, really get to be an expert and follow the companies in those industries, analyze the companies in those industries, so you know which companies are the best stocks in those industries. And that might only be maybe 5 or 10 stocks at most, right? That you really think are the best of the best in their specific industries. And then to get that diversified portfolio, that little bit more safety in your overall portfolio, then you'd pick maybe a whole index fund, the SPY or the VOO that just covers all the stock market, or maybe you just buy the other sectors in their select sector spider funds, right? So that's going to give you the market return. That's going to give you the return in those sectors that you really don't follow, you really don't know anything about. That's going to give you a nice smooth return in those. And then those 5 or 10 stocks that you really have studied, you really have researched within those industries, those will give you that extra return, that extra alpha, right? And again, so to your question, how do you pick those sectors? Well, again, it's what do you want to focus on? Do you want to focus on growth? So maybe those 5 or 10 stocks, they're in those growth sectors, the technology, the communication services, the consumer discretionary. Maybe you overweight those a little bit in your portfolio. So maybe you have 20, 30% of your money in those 10 stocks, and then the other, 60, 70% in the overall market. So that would give it a little bit of growth bent, right? Or, conversely, if you want more of a dividend focus, then you would focus on those sectors, or a safety focus on those sectors, and you would overweight your portfolio, right? So you're not just picking one sector, even if you were to become an expert in the technology sector or in a few industries in there, you're still not putting all of your money in tech stocks. That'd be kind of ridiculous, right? I mean, after the bubble burst in 2000 in tech stocks, I mean, it took 14 years for the Nasdaq to get back to the level it was in 2000. So to have all your money in tech stocks, you're just begging for that kind of a crash. Um, so
Well,
overweight those sectors that have that kind of growth or not growth, that kind of focus on what you want to focus on. But then, yeah, invest more broadly across the market in just, ETFs and index funds, things like that.
if you feel some type of way about people being overweight in the NASDAQ, I think we just need to resensitize you to like Wall Street bets where people are betting their entire life savings on zero DTE in NVIDIA, one
Exactly.
stock.
Yeah. Yeah. And I hate bull markets. I gotta say, I hate bull markets sometimes because everyone is an expert and everyone knows the best investment, right? You say one bad thing, you say one, I won't even say not even a bad thing, but the bear case on on a hot stock, on Nvidia, on
There
Palantir.
isn't
You
one.
say how it's just crazy expensive. And people are like, well, I've made 300% on Palantir, so shit on you. I'm the expert. I had one comment, yeah, it's a couple of weeks ago, and I was saying in Palantir, this is when it was right around $80 a share, and it's back down to around 67, 70, I think now. But I was saying, hey, I mean, to at this valuation, it would need this kind of growth for decades out in the future just to make it, kind of a breaking even investment. And there's just ridiculous valuations. And somebody came back with, oh, hey, 10 years equity analyst, CFA designation, all that. I've got none of that, and I already made 300% in Nvidia. So now who's the asshole? And somehow this guy is right? Because he's made money, and I'm sitting here saying don't buy Palantir. Uh, so
Well,
yeah, it's just kind of it's how the market works.
one of the things I always remind people of is, in my opinion, I just wrapped up my 18th year of trading last year. And in my opinion, the dominant display of mastery of the skill set is endurance.
Oh yeah,
So
definitely.
I'm very happy that he's made 300%. Let's come back in a decade and see what it looks like.
Yeah,
Like, and
yeah.
it's not wishing bad on anybody. I want them to make money. But a lot of people, I think, really confuse, exactly to your point, short term sequence of returns, the path, and they confuse it as strategy.
Yeah,
And
yeah.
it'll
And
catch everybody.
I won't say I'm any better. I mean, hell, when I first started investing, back with my $1,200 I was making as a corporal in the Marine Corps,
Oh,
I was momentum investing. I was buying the hot stocks. I didn't know shit from
of
Shinola as
course.
far as stocks or analysis or anything. I was just buying what everybody was talking about, right? So I have probably learned more from my mistakes than I ever did learning as an equity analyst and venture capital analyst and all that. It's just, when you've been investing for 25 years now, then you make a lot of mistakes. And if you learn from them, then that puts you ahead of the 70% of investors out there that either haven't made the mistakes yet or you made them but just didn't learn anything and just keep on repeating those same mistakes over and over again.
Beautiful segue into a couple of my last questions for you. It's always fun to poke fun when somebody else gets hurt, provided that they're not hurt too bad. So let's talk about the hurt. Let's talk about some of the mistakes when you look back over your trading career. I'd like you to break out a handful, whatever number you feel like, but I'd like you to break it out into two distinct buckets. I would consider there to be beginner mistakes, which is often just not knowing what you don't know. And those are kind of easy things, right? Once you're educated on them, then you can typically avoid those. So I'd love to start with a couple of those. And then just to prime your brain, and I'll remind you if you need the question again for the second part, is what would you consider some of the more advanced mistakes? And these are things that typically occur later along in your tenure. You have some experience and there's still something that shows
Sure.
up that pops you out of nowhere.
Sure. Well, the beginner mistakes are just what you see on a lot of YouTube right now is just that chart porn, just
Okay.
following a chart up and thinking it's always going to do that. Investing just because that happens, or really even saying somebody's saying it happens. There's a lot of YouTubers out there that basically, do no more analysis than just looking at a chart. And I'm not talking about technical analysis and actually knowing the trends and patterns to look for. I'm talking
Mhm.
about just eyeballing a chart and loving that it's going up and saying, hey, let's ride it till we fall off. So that's, that's probably the biggest mistake I see new investors make, and I made, myself way back ago. So I think that's an easy one. I think the PE ratio, following the easiest measures that and really not knowing what goes into them or why some of the pitfalls or traps in them. So again, we talked about the earnings on an income statement and how manipulated it is, and why that makes that PE ratio a little bit not quite as valid as you might think, right? So maybe going a little bit further into the price to cash flow or some of the other measures is a better bet there. I think that kind of basic analysis and basic investing, I think, is the biggest mistakes I see people make. There's I think I want to say the Dunnings-Kruger graph,
Dunning-Kruger effect.
you're
I talk about
right,
it all the time.
Dunnings-Kruger effect, where
Yep.
you learn a little bit and you're right at that peak stupidity, I think is where they call it, where
Stupid. Yep.
you know just enough to make yourself dangerous, right?
Yep.
And I think that's where a lot of investors find themselves at. They put in a couple hours a week to look at stocks, and all of a sudden they know exactly where things are going and what to do. And it's really only when you start to, usually when you start to make those mistakes, only when you hit that first bear market of your investing life, and you really start to see some of the stupid things you were doing, that you really do start to learn. Okay, this is what I don't know. This is what I need to learn, and that kind of thing. So really, it's unfortunately, I think for a lot of people, it's just that those mistakes have to be made, and it would be great to be able to say, hey, you know, don't just follow a chart up, don't just buy what's going up, that kind of thing. But it's almost like, it's almost like my 8-year-old. You tell them all you want, you give them all the advice in the world, but they're not going to listen to you. They just have to make those mistakes themselves, and tell their 8-year-old when they have it about those mistakes. Uh, I think that maybe a little bit higher level mistake is learning how to, watch the debt that a company has. I know a lot of us, we love a great deal, so you look at a stock that's just falling off of a cliff. You think, hey, it must be a great stock, it must be a great deal. So you just buy the shares, right? Without looking at, okay, well, one, market's pretty smart. Usually when a stock is going down so much, it's for a reason, so what does other people, what do people see that maybe you aren't looking at? And what's the bear case for the stock? But more importantly is watching that stock and watching the debt on the company's balance sheet, the cash flow. It goes really. This is where the cash flow statement comes in handy. Is okay. When does that debt come due? What's the cash flow trend in the operational cash flow, and how much cash on hand do they have to pay if it's a negative cash flow, but also how much debt do they have and what are those interest payments like? Because even a great looking company can get into a lot of trouble if they have too much debt. I mean, case in point, probably my biggest loss ever was Peabody Energy, right? Coal producer. This was probably 2012, right? And all the coal producers were just falling off of a cliff. The government was really coming down hard on coal producers, trying to move everybody into renewable energies and natural gas and things like that. So yeah, the coal producers were just dying, and so I saw that, and I thought, well, hey, yeah, the future is in renewable energies, the future is in natural gas, but at the time, coal was still, I think, something like 37, 40, 42% of electricity generation, right? So it wasn't going away anytime soon, right?
Right.
So I thought, okay, you look at this industry, coal industry, who is the strongest? Who's the best house in the shitty neighborhood, right? And Peabody, it had that size. It was one of probably the largest publicly traded coal producer. Um, so I thought, okay, here's a company that, yeah, it's beaten down just because the entire market is beaten down for coal producers. It's not anything management did. It's just a horrible environment. So once that environment improves, once the environment for coal improves, this stock should go to the moon. So I invested in that, and of course, followed it all the way down. One of the biggest mistakes an investor can make is, that dollar cost averaging. That isn't a
Hell
bad
yeah.
idea, but that
Throwing
dollar
some good
cost
after
averaging,
bad.
yeah, all the way down, catching that fallen knife, and of course, they eventually filed bankruptcy because, you know, even though eventually, and hell, coal has been a great investment over the last few years, over the last 5 or 6 years, I think. But it didn't turn around quick enough for the company to
Right.
get out from that massive amounts of debt that it had on the balance sheet. So they just owed too much debt, and ended up in bankruptcy. So I lost quite a bit of money from that actually. And yeah, if you're gonna be if you're gonna be chasing those value companies that have just sold off, 30, 40, 50%, one, you gotta figure out that bear case, and you gotta follow it. You can't close your ears just because somebody is saying something negative about a stock that you think you might like. And then you gotta look at that balance sheet, you gotta look at the cash flows, and that debt.
I love that too because it also highlights a really common thing in terms of the temporal relationship of your assumption with when it actually ends up playing out. Because to your broader point, the thesis ended up being correct, but just the
The timing.
timing, the
Yeah.
timing hurt you.
Oh yeah, timing is, you look at, well, okay, what, another one of my best examples that I like is, everybody loves the movie Big Short, right?
Yeah.
And of course Michael Burry always loves to point out that he predicted
Right.
the housing crash. Well,
Almost
he
took
was trying to
involvement.
predict it in 2000. If you follow that, watch the movie, and you actually follow what actually happened, he was trying to predict it in like 2002,
Yep.
2003. Okay, so he was about 4 years early. If you actually watch the movie, he only kept his firm, his capital management, his firm,
Yeah.
out of bankruptcy because he just stopped returning investor money.
Yep.
People were asking for their money back, and he said, "Nope, I'm suspending all withdrawals right now." So that is the only way that he kept his firm out of bankruptcy. Uh, but he ended up being right. So bully for him. He became a big star, and you know, uh, but uh, but yeah, being yeah, one of the biggest lessons I've learned is being early is just can be just as bad as
Yeah.
being wrong.
Yeah, and
So
sometimes it's even worse because
yeah,
if you're early and you still have conviction, you start throwing more money at it because it's
exactly.
losing, and you're like, I still feel this is going to happen. Yeah, no, I literally couldn't
Exactly.
agree more with you there. And it's funny because I always think how razor thin the margin is between like genius and idiot. And that example is that razor thin margin. He's a
Yeah.
genius because it worked. But just, I always
But
think of it in terms of probabilities. That's a lot of my background is in stats. So it's like, how many other versions of this happened with other people, different funds that failed on this
yeah,
same idea, but just couldn't make it across that finish
he,
line?
he was so overextended in this one bet that
Yep.
it almost destroyed his firm. There's a point where you got to go back to, Warren Buffett's old, or what's attributed to him. His old saying is just, rule number one: don't lose money, right?
Yep.
So
Solid approach.
you may feel you've got the inside scoop on the company, or a company, or the economy, or the market, where it's going. But if it means, placing bets, placing outsized bets on one direction, and hoping that turns out, those binary bets like options, where, you could lose everything if you're wrong, then you got to think, okay, what if I'm early? What if I'm really early on this? What does the future look like for that? And then kind of try to hedge some of that, and really, I mean, it's not wrong to place, directional bets, and put conviction, or put money behind your conviction. But again, what happens if you're early, and what does that look like?
Well, it also goes back to the point we were talking about before is, placing bets with conviction is one thing, but survival is another. And again, to me, the ultimate mark of a seasoned investor or trader is tenure, it's duration. So yeah, you might be worried about getting that thousand bagger that you're super convicted in, but if you mortgage the house on it and you're wrong, even if you win, if you apply that methodology going forward, you're gonna unwind it at some point. I always find that part really funny, how there's a lot of really, really, really smart people that have done really great in the markets. There's a couple super famous ones that have done really great in the markets, but then because of like mistiming and things like that, they end up losing all their money.
Yeah.
Um, Yeah, it'll get you sooner or later. It's like the
Yeah.
casino. As long as you keep coming back, you have to have good bankroll
It'll hit
management.
you eventually. Yeah. What was
Yeah.
the and this one I can't remember the firm, but it was what's the hedge fund that was in the recent GameStop movie, right? That kind of the whole
Citron?
huh? Uh
Citron?
yeah, I think that was the one that folded. The one that was played by
Oh, Melvin.
yeah, Melvin. There you go.
Melvin
I mean,
Capital. Yeah.
yeah, he's a smart guy. He had a history behind him. And then yeah, he just went so far into that one trade, overexposed in that one thing, and that was it. There was $12 billion loss. Just losses adding up to where it broke him. So yeah, the you can make all the money you want, but if you continue to turn investing into gambling rather than investing, then it's gonna, like you said, the house is gonna win eventually.
GG's for them. Well, absolutely awesome to connect with you. I actually, I'm going to follow up with you after this to see if we can book a follow up because I think it would be really, really cool now that we have a baseline of kind of like who you are, your background, what you're about. I'd love to do a follow on where we kind of talk about 2024 and then 2025. So I find these 2 years to be really, really interesting from just a broader like market and economic perspective. But thank you so much for coming to hang out. Before we wrap up, though, where can people find you?
Sure. Well, let's talk money. They're right here on YouTube. Love to see people come over, join the community, become part of the community, and let me know what kind of videos you want to see.
Beautiful. Well, I'll also throw a link to that in the notes below. But thanks for hanging out, man. Absolute blast.
Thank you.